Hello and welcome to this webinar, which is jointly organised by FASTA, the Foundation for the Economics of Sustainability, and the Cork Environmental Forum. My name is Caroline Whyte and I have a background in ecological economics and I do research and advocacy for FASTA. I'm delighted to be participating in this event on banking on the community, and I'd like to thank the Cork Environmental Forum and particularly Bernice Connolly for acting as our Zoom host today. And Councillor Dan Boyle also, who's given us a lot of support in our preparation for this event, and Sean O'Conloy from FASTA as well. This seems a very ripe time to be seriously considering different approaches to banking in Ireland. I'm sure I don't need to remind those of you who are listening in from Ireland that Ulster Bank has recently decided to pull out of the Republic, and the Bank of Ireland is closing 88 branches in the south and some in the north as well. The banking sector is also still feeling the after effects of the 2008 crash, and there have been issues in the intervening years, such as the tracker mortgage scandal, which have caused a lot of concern. In a little while, we'll be hearing from our panellists, Gerry Duddy, Bridget Meehan and Neasa Hourigan. Our original speaker from the Public Banking Forum of Ireland, Seamus May, is unwell, unfortunately, so he can't attend today. But Gerry Duddy, who's also from the forum, has stepped up to the plate and agreed to give a presentation, which we very much appreciate. Gerry is the Secretary and Researcher for the Public Banking Forum of Ireland, and he's been involved in the forum since 2014. Bridget Meehan is based in Northern Ireland and she's a left activist and a public policy researcher. She's the co-founder of Collaboration for Change, which is a network of progressive activists across Ireland. She's also a member of the writing group Collective 20, which is a small group of people around the world, including Medea Benjamin, Michael Albert and Noam Chomsky. Today, Bridget will be talking about the Northern Mutual campaign, which she's co-founded and which is campaigning for a mutual bank in the north of Ireland. Finally, we'll be hearing from Neasa Hourigan. Neasa is a Green Party TD for the Dublin Central constituency. She's Green Party Finance and Health spokesperson and Chair of Policy Council. She has a professional background as a specialist in creating sustainable communities, and before becoming a TD, she was a university lecturer in environmental development and design. We're very pleased to have such a diverse range of panellists today, but we also realise that there are a great many different voices now calling for changes in banking in Ireland from lots of different backgrounds and political stripes. For reasons of time, we haven't been able to include all the different voices on our panel. However, we very much welcome other perspectives as well as those we'll be hearing from directly now. We're hoping this will contribute to a serious and substantive discussion about the future of banking in Ireland. I'm going to start by quickly taking a look at some of the background context for what's happening in finance at present. So I'm going to zoom out and briefly look at the bigger picture of the road of money and energy globally and tease out some of the links between community banking and the regenerative and resilient economy. So FASTA is a member of the Wellbeing Economy Alliance, which is a global network that's trying to shift the economy's orientation towards well-being and away from growth as an end in itself. And one of the ways it's doing that is by changing the narrative about the economy. In other words, the way the economy is perceived, what's seen as goals of the economy and the relationship between the economy and the environment. Now, the most prominent narrative about the economy in the media and policy circles at the moment is still that the economy is something that can expand indefinitely, and the environment or the ecosystem is something that's embedded within it, something that you can extract things from and dump things into. And this is a graphic that was done by Herman Daly, who's one of the earliest ecological economists, and his point of view, and mine too, would be that that's putting things upside down or the wrong way round. In fact, really, it's the environment that surrounds the economy. And this chart here, it's got in the middle, the green bit there is the economic donut, which was devised by Kate Raworth, who's another ecological economist. And the donut is the safe space for humanity to live in. And the red areas on the outside and the inside are places where we're in trouble. And the outside areas involve the environment. So you can see from this diagram that we're in trouble with climate disruption, biodiversity loss, and some other things as well. And we also have some social problems as well, with people not having their basic needs met in food, water, health, access to education, and so on. So there's quite a challenge here. We have to really figure out how to get the economy to go into the donut so that we don't have these red areas anymore. So if we just look briefly at climate in particular, there's one of the challenges here is that there's a very strong historical link between gross domestic product or productivity generally and emissions of carbon dioxide. And it's actually proving very hard to decouple that link. There's been lots of claims that it's happening, that this decoupling is happening. But in fact, there's a huge mountain of evidence at this point, which indicates that in the aggregate, it's really, really hard, if not impossible, to decouple environmental degradation generally from economic growth. This particular study I've got on here is from the European Environmental Bureau, and it's quite wide-ranging. And there are lots of other studies as well. Another element in this whole mix is that whenever you use energy, and energy is very, very central to the economy, of course, the economy basically runs on energy, you are going to be using some energy to get at the energy. And so that's what's called the energy cost of energy, or some people also call it energy return on energy invested. It's the amount of energy that you need in order to make energy available of different kinds of energy. And so we all know we have to shift to renewables for energy supply, and there's a lot of hoo-ha in the media about the fact that renewables are getting cheaper. And that's borne out by the middle graph in this diagram, which shows that the energy cost of renewables is going down, which is positive, of course. But there are a few things to bear in mind. One is that with renewables, there's going to be intermittent supply and challenges to do with energy storage. And the materials necessary for renewables and for providing the energy storage of the renewable energy are finite as well. And importantly, fossil fuels are still used for the installation and fabrication of renewables. And another thing that maybe should be getting more discussion really is that high quality fossil fuels are getting harder and harder to access. And you can see that from the graph on the left here. On the face of it, that might seem great from a climate point of view because it makes it harder to produce greenhouse gas emissions. But in fact, it actually makes the energy transition more challenging. As already mentioned, we need some fossil fuel at the moment in order to be able to access renewables. And as I'll argue shortly, we currently need the kind of productivity expansion that only fossil fuel can supply in order to keep our financial system functional. So that's another whole element to this. The rising energy cost of fossil fuels is probably an underlying cause of the secular stagnation that's been causing so much consternation in recent decades. And the previous graph I just showed was by an economist called Tim Morgan, and he's calculated that the energy cost of energy was 3.6% in 1998 and increased to 7.9% last year. And he thinks that a full transition to renewables will have an energy cost of energy at around 10%. And in the 60s, it was less than 2%. So there's a big change happening, basically. If we take a quick look at the breakdown of energy sources in the global economy, we can see that despite the message we often hear in the media, fossil fuels are actually still very dominant and their use is expanding. Renewables are expanding too, but their share of the overall energy mix is tiny. It's a little green sliver near the top of the graph there. In Ireland, transport is the most energy consuming sector of the economy, and it uses 42% of the energy share. So what kind of energy does transport use? Well, despite all the focus that's being put on electrification, you can see here that the vast amount of energy for transport still comes from fossil fuels. So if we're seriously going to heavily reduce our energy consumption and phase out fossil fuel use, a very good place to start would be in localizing economies wherever possible so that we're less dependent on transport in order to be able to survive and thrive. And community banks, as we'll see, are part of the mix for localizing economies. So one final point I'd like to make about the energy transition is that I think it's rendered much more difficult at the moment by the fact that we currently have a financial system that depends on productivity expansion, like GDP growth. Empirical evidence suggests that maintaining a stable and dependable money supply depends on constant credit demand. And you only get credit demand if people feel confident that they may be able to pay back their debts in the future. And that means that the economy needs to keep expanding. Because of the way in which most money is currently introduced into the economy, the money system acts like high blood pressure on the environment. It's a silent killer. To keep enough money flowing around the economy has to keep trying to expand in the aggregate, even if it's no longer able to do so because of resource limits and environmental damage. One of the unwanted side effects of this pressure to expand is that money tends to congregate where there's already high GDP growth and quickly leave areas that are economically deprived. Richard Dowthwaite, one of Feasta's founders, described in his 1998 book, Short Circuit, how for every £5 or £6 that were deposited in a local branch of a commercial bank, only £1 would actually stay in the area. The rest would immediately leave for elsewhere. So money will tend to quickly leak out of a community where GDP is low. And we're seeing the same phenomenon now And it's described in a much more recent publication called Fulfillment, which focuses on the practices of big businesses like Amazon. Amazon's warehouses are called fulfillment centers. And it gives the example of two cities that are quite close to each other, Washington, D.C. and Baltimore. Row houses are being knocked down in Baltimore, and the bricks are being transported to Washington, D.C. to build very similar houses there. The dynamic is actually bad for both cities, even the rich ones, because it becomes overpriced and congested. So how can we break away from all of this and change the economy so that it can fit into the donut? Well, in Feasta, we have a theory of change in which we've put the donut on three supports, and they represent things that we think are necessary for it. And the idea is that if you take one support away, the whole thing will fall over. So we need them all, or something like them. And one of the things that you can see there holding the donut up is fair green money. Now, fair green money has a number of aspects, and I won't talk about them all now, but community investment is an important part of the mix. Community investment basically means finding ways to keep money circulating in an economy, in the local community rather, for as long as possible, rather than allowing it to immediately leak away. There are lots of different forms of community investment. For example, you can buy shares in local businesses, as in this picture from Short Circuit on the left there. It's of shares in a locally owned restaurant in Massachusetts, or you can join local investor networks such as the slow money movement in the US that provides 0% loans to local food producers. Then there's community wealth building through anchor institutions, which makes use of the procurement procedures of large institutions in the community like hospitals or universities to channel investments more locally. And by the way, the nice graphic in there comes from a very good publication called The Question of Scale that was published by the Green Foundation Ireland and Cultivate recently. Last but not least on this diagram is community banking. So I see community banking as being like a bicycle. It might seem very unglamorous and even humdrum, but in fact it's incredibly energy efficient. Cycling from A to B takes 5 times less energy than walking the same distance. Community banking, by keeping money local and not allowing it to leak out of the community quickly, can conserve our community's energy in a similar way. And as we've seen, it's energy conservation that we really need to focus on now and in the future. Community banking can also be a form of biomimicry, which seeks to imitate the way things are designed in nature. Biomimicry is used in things like engineering, and it seems pretty central to a lot of thinking about the circular economy. Here's a writer on the biomimicry.org website waxing lyrical about the similarities between community banking and living systems. That last sentence, which mentions qualitative expansion rather than quantitative expansion, is interesting, given the limits to productivity growth I've been talking about. I think we need to be careful about the specific design of community banking so as to make sure it doesn't have any GDP growth dependency built into it, but it can be done with some thought. Finally, I'd like to just say a few words about narrative. You probably all know the story of It's a Wonderful Life, which you could say has a community bank, Buildings and Loan Society, as one of its principal characters. The film tells the story very nicely of how, thanks to the bank's existence, people in the town of Bedford Falls have access to housing, which they wouldn't have otherwise. And housing is a very emotive issue in Ireland, obviously. One flaw in the story that was recently highlighted by Patrick Denede is that it paints American suburbia with its dependency on cars and its lack of front porches and convivial spaces as a kind of paradise which everyone aspires to. So the photo on the right here shows the actual location now of the place where the new subdivision in It's a Wonderful Life was filmed in the 1940s in California. To be fair, there's some nice mature trees there, but the main impression I have is of tons and tons of tarmac. It's not the kind of vision of the future we need. And there's a reason why community banking, or indeed other forms of community investment, isn't enough all by itself to enable us to achieve the energy transition and to be able to live within the economic donut. So that's why, as I already mentioned, Feasta's theory of change includes a number of other things that are propping up the donut, as well as fair green money. It's also rather thought-provoking to me that although it's really the community of Bedford Falls and It's a Wonderful Life that saves the day in the end, there's a rich guy called Sam Wainwright who also chips in a massive sum of money. Doubtless this seems too cloying to some people who see the film. There's another rich guy in the film who you can see on the left here who isn't willing to budge an inch, but it seems clear that one way or another, a lot of wealth is going to be redistributed before we're through with the energy transition. This is because the only other way to tackle debt, apart from GDP growth, is to directly cut back the debt itself. That could happen in different ways, with varying degrees of pleasantness. There could be hard defaults in the form of mass bankruptcies and so-called soft defaults in the form of inflation. And perhaps, who knows, also some voluntary transfers of funds, a shift towards spending in the economy by those with the means to do so. spending in the community. My hope is that the energy transition will largely be peaceful and perhaps sometimes even done with goodwill and in the spirit of friendship, as we see in the film. Okay, thank you very much for listening. I'll pass the baton on now to our next speaker, Gerry Duddy, who will be outlining aspects of community public banking, the German model and the Irish situation.
Thanks for the opportunity to speak with you today, and Seamus sends his apologies that he couldn't make it and filling in for him. Banking on the Community, brilliant title, and delighted to cover it today. This is basically just what I'll run through: banking as a utility, current financial system. I have a slide there from Professor Steve Keane, and how the commercial banks control the economy via controlling credit. Look at the German economy and the huge SME sector that's there. The German three-pillar banking system, credit for the productive purposes, was a slide for Professor Richard Werner there. Government solution, what the Irish government started doing in 2017, around that time. And then we talk about the post office crisis and the Kiwi Post Bank option, a proposal for them, and what's needed. And then we look at the future, the central bank digital cash. So just to talk about banking as a utility, what's the current banking system we have in Ireland, and particularly mostly the West, is a wealth extraction system where the banks are taking up to, as Professor Steve Keane says, up to 30 to 40% of the profits of the economy. So this is why we're struggling so much if you have the banking system taking that amount. So just the next slide. This is a slide from an interview by Professor Steve Keane. And he says in that, finance, of course, has to make a profit in its own right to be viable. You need a financially successful, profitable banking sector, but you do not need one that's 30 and 40% of the profits of the economy. Because of that level, it's actually siphoning off money being generated in the real production of industries, the industrial section, the agricultural sector, and the mineral sector. And then he goes on to say, ultimately, the financial sector should be the servant of the rest of the economy, not its master. But at the moment, it's the master of not just the economy, but of the politicians as well. So we need a complete political shift to change things. So that's also Ellen Brown of the Public Banking Institute in America has come up with the same figures, 30 to 40% being taken over the economy by the banking system, the current financial system. We move on now to have a look at the German system, the German SME sector, which is 2/3 of the German economy is SMEs, small and medium-sized businesses. And if we look there on the top left-hand corner, you see that 87% of all businesses in Germany have a turnover of less than 1 million per annum. So that's 87% of all businesses. That's a colossal figure. I think that Germany is the fourth biggest economy in the world with exports equivalent to China. So there's thousands, millions of small businesses in Germany with turnover less than 1 million. And that's figures by the KfW in 2015. KfW is a German state bank that funds large infrastructure projects and the like. So then down to the bottom right-hand side here, micro enterprises with less than 10 employees provide 34% of the workplaces in the German SME sector, and 70% of those are based in rural areas. And it was the UK Economist that put out those figures in 2010. So we have loads of potential in Ireland, as you can see. Like, why don't we have more of these businesses generating less than 1 million per annum? We could have this. Then down the bottom here, nearly 99% of all businesses in Germany have an annual turnover less than 10 million. When we look at Germany and think about Germany, we think of Mercedes and Deutsche and BMW and Siemens and all those national corporations. But in fact, 99% of businesses in Germany have a turnover less than 10 million. So it's mainly smaller businesses. So then if we look at this one on the left-hand corner down here, between 2008 and 2011, the Sparkassen, which are the public savings banks in Germany, increased the lending in the crisis to small and medium-sized enterprises by 17%. So what happened in Ireland? The banks called in the loans and the businesses shut down, whereas in Germany, the public savings banks pushed the credit. There's an interesting short video there on the YouTube interviewing the Sparkassen manager, and he said, paraphrasing, in Germany, there was no crisis. We pushed the credit, we forced the credit. So they supported the businesses to keep them in business until the crisis was over. So that's the German SME sector. 2/3 of the jobs, similar to Ireland, SMEs provide approximately 2/3 of the jobs, or at least they did before the lockdowns and the current situation. This is the three-pillar system banking in Germany. And they have basically three pillars: commercial banks, cooperative banks, and the Sparkassen public savings banks. And as you can see there, the commercial banks have only 12.5% of the market in Germany. That includes Deutsche Bank and Commerzbank, two of the largest banks in Germany. So they have only 12.5% of the market. Then the cooperatives and the public community savings banks have nearly 70% between them. So we have a lot to aim for in Ireland. You can see there the objectives of each one. The cooperatives is financial services for small and medium businesses, including farmers. Sparkassen Savings Banks is a financial service for low-income people, startup businesses and SMEs. And their orientation of interest, the cooperatives are member-orientated, and the public savings banks are public welfare task-orientated. They have to provide an account for everybody. That's one of their mandates, and the stakeholders of the community. So, and their purpose as well is to fund startup businesses. That's the three-pillar system. And as you can see, or as I said, there are 12.5% commercial banks in Ireland. It's all commercial banks. Probably about 97% of the banking in Ireland is commercial banking. We have the credit unions with around 2.4% of the market, but they're not banks. They cannot create credit. So moving on to the credit for productive purposes. This is a slide by Professor Richard Werner. He's German professor but works in the UK. And the creation of credit and where it goes to and the purpose it's used for, which is controlled by the banks. They control how much credit is created and where it goes to, what it is actually used for. The productive credit used for productive investment, like technology, products, services, added value to current products and services. So more money and more goods and services. So there's income streams are generated to repay the loans. And he says you can have growth without inflation, and that is sustainable. But then the bad credit is consumptive credit for assets, creates property bubbles and inflation, boom bust cycles and crisis, because it's not sustainable. If you create a boom, the bust has to follow. It's common sense. So the next thing is, this is the figures from the UK on the decade up to the crash of 2007 and 2008. And this is where the funds were actually going before the collapse. So you can see there 32% direct to the financial sector, 31% towards mortgage lending, 20% towards commercial property, 8% credit cards and personal loans. So only 8% went to businesses outside the financial sector. And of that, only 3 to 4 ended up in the productive economy to create new jobs, new services, new infrastructure, and develop new technology. So, like, if that's all that's going into the productive sector and productive credit, we cannot progress and have a sustainable system. So the figures maybe are similar for here, or possibly even worse, because we're big into our mortgage lending here and property lending. So next thing is the government solution to supporting SMEs. We made a proposal in 2017 to the Finance Committee to create an alternative banking force for Ireland, incorporating the credit unions and the post offices and new community banks. And this is the solution the government came back with, which is called the Strategic Banking Corporation of Ireland. So what is happening here? The Strategic Banking Corporation of Ireland is getting funds from KfW, which is a German public state bank, the European Investment Bank, and the Irish Strategic Investment Fund. These funds are going into the Strategic Banking Corporation of Ireland, right? They're then on-lending them to the commercial banks, Bank of Ireland, AIB, and Ulster. Well, Ulster is gone now, but whatever, at 0.8%, right? But these banks were then on-lending them to businesses at between 5 and 5.5%. So the markup there was absolutely huge, between 4.2 and 4.7%. Now, recently they have dropped them to 3%, but that's still a 2.2% markup. And here's the kicker. The loans are 80% guaranteed by the state. So the Strategic Banking Corporation was guaranteeing the loans that the AIB in Ulster and the Bank of Ireland were giving out to the businesses. So very little liability for the banks. in doing this, and huge profits, huge markup on the loans. That's still in place. The Strategic Bank Corporation is still in place. Like I say, they've dropped their rates a bit, but they're still there. Then we move on to the post office crisis. What's happening in the post office at the moment is, starting in July, up to 600 post offices in Ireland will start to close because of lack of business. They are heavily dependent on government contracts, and basically a lot to do with the lockdown. Up to 30% of transactions have gone directly to the banks. So the post offices have lost a lot of businesses, a lot of transactions, and they were dependent on them to survive. So come July, a lot of the post offices will be in serious trouble. In 2018, the IPU, the Irish Postmasters Union, set up a new contract with the An Post, and from that contract, new business was to be introduced to the post offices, but this hasn't happened. Nothing has been done. So it's another reason that the post offices are really in trouble, and will be in July. So they'll start to close. But here's what was done in New Zealand in 2002. They set up the Kiwi Post Bank, Kiwi Bank it's called, but it's a post office bank. Founded in 2002, a Labour-influenced government made it happen there. And in the first 5 years, they have 500,000 customers, population a bit less than Ireland, but similar. And they have 4.1% of the banking market. But the key thing is that you have public banking in every post office. This is the thing. And they also do insurance and other financial services as well. They're very proud of it, that it's their own, because what was happening is New Zealand was being pillaged by the large Australian commercial banks. So this is an interview from the CEO of Kiwi Bank, talking about the success of it in 2018. But we get into the figures here of how successful it is. So he said the underlying profits risen to 126 million in the year end of June. That would have been 2018, their year is June to June, up from 122 million in the previous year. So they're taking in around 122 million or so every year, and this is not for private shareholders. This is going to the government or going to the local, local council or whatever. So it is possible to introduce it here. It's a no-brainer, but there's opposition, obviously. So just to get down to what we actually need in Ireland, what needs to happen. We need community and public banks, various types, such as post office banking, like the Kiwi model. We need community public banks like the Sparkassen or the cooperative banks. And we also need the credit unions to step up to the plate and start to take a bigger role. In Canada, the 4 or 5 largest credit unions, they're large credit union entities, they all have banking subsidiaries. It's the only way they can compete. So there's 4 or 5 of them there. They're very large credit unions, but they all have banking subsidiaries. And we must remember that in Germany, 70% of the banking is community banking, community and public banking. So we have nothing in Ireland, only the credit unions, who are not banks. So yeah, we should be aiming for 50% at least. And the reason for doing it is to take back control of the creation and allocation of credit to the community and to the public. As regarding the allocation, this is the issue we have talked about earlier, that the credit is going to investment in property and speculation, not into the community for creation of jobs and services and sustainable growth. And well, there it is, credit for productive purposes, not speculation. Just a last slide then on what is coming in the future, central bank digital cash. This is being trialled in several countries. Turkey is doing it at the moment. It's being done in India. And Christine Lagarde here of the ECB says we'll have it within 4 years. Now, this little short interview here on YouTube talks first about how there's a consultation system in place and they've got several thousand comments and feedback and they're analysing all them. And then she goes on to say at the end of the interview, we'll have it in 4 years. So it's happening, there's no question. And this is the head of the BIS, Bank of International Settlement, clarifies the difference between cash or ordinary cash, notes and coins, and central bank digital cash. He says the key difference with central bank digital cash is the central bank will have absolute control on the rules and regulations that will determine the use of that expression of central bank liability, and will also have the technology to enforce it. So the central bank will determine the use of the cash and will have absolute control. So that's it. Glad to answer any questions I can at the end. Thank you.
Yeah, thank you very much, Gerry. That was really interesting and very striking to see how little investment actually goes into real productivity. Quite something to keep in mind there. Quite interesting. I'm going to move on. We're going to take questions, but we decided we prefer to put them at the end because then we can group them, by theme. So we're going to move on now to Bridget. Are you ready, Bridget? You have your presentation there?
Okay, so I'm going to talk about mutual banking today, and it's very similar to what Gerry's talked about. I'll take a different sort of spin and give you different sort of information, but really what Gerry's trying to do with his campaign, what we're trying to do here, we're trying to achieve the same thing using slightly different terminology, but it's all about the same thing. So thanks for having me here today, and I'm in the north of Ireland, working out of a different jurisdiction, but I just see us as all living in the same country, really. So I don't like to kind of make massive distinctions. Okay, so just very quickly, what mutual regional banking is. So it's an alternative approach to banking. So we know the privatized system, Gerry's talked about it, and the mutual approach is saying, let's democratize this money, give us back control of our money, let us have a say in how it's used. We do have a lot of wealth, but it's getting siphoned out because of the private system. So let's see how we can bring that back for our own use. There's unique features that mutual banks have over the high street banks. So obviously they're mutual, that's like they're owned by their members, not by shareholders, which is so crucial because the mainstream banks, their raison d'etre is to make profits for their shareholders. No matter how much they pretend that they're providing a service for their customers and all the rest of it, the customer is secondary to making profit. So your needs as a customer, my needs as a customer, will always come second to what they need to do to make profit. And that's a key difference. So the mutual banks are also regional, so they'll serve a specific designated region only. So in our case, it'll just be the north here. And members must live in or be connected to the region. And the whole point is that the money that's deposited there is recycled back into the region. So that's the wealth of the region being recycled back and staying within the region to be used in the productive economy. So then that allows you to prioritize local businesses and co-ops and their specific needs. I saw a question in the chat where, SMEs don't need to borrow a lot. They probably don't do a lot of borrowing, but they do need cash flow. They do need a small overdraft, maybe to get them through a certain time of the year, whatever. And the big banks don't really like that. They like the bigger customers with the bigger loans. And that doesn't really suit the small businesses, but the mutual bank will be more focused on what the needs really are for small businesses and small enterprises. The mutual is also ethical, so it's not profit driven. Yes, it will make profit because how else is it going to sustain itself, but it's not driven by profit the way the mainstream banks are and their need to kind of satisfy their shareholders. Instead, they're more purpose driven, and the purpose is really what is best for the people in the region, what's best for the environment. And then it's very much about financial inclusion as well. So no one can be refused a bank account if they actually live in or are connected to the region. And that's something that I know we've got it here. You probably have it in the south as well, where there's a lot of people who cannot get bank accounts for whatever reason. And that kind of financial exclusion can cause a lot of problems. And there's poverty premiums as well when you're not able to kind of pay for things through direct debits and so on. So there's a lot of different issues that arise with financial exclusion that this model would address. And we're also about, access to cash in branches. So there's a real push, Gerry talked about this too, on you don't need branches, you don't need money really, you can just get by with doing everything online digitally. But people actually do need these things. It's profit driven really to close branches and to close ATMs and to close this access. And like I've just got the figure there, 316 branches lost here in the north since 2015. So the mutual model will try to address this as well. So I'm just going to go through a couple of schematics here to just kind of show you the landscape now with the current model of banking, and then how we can, our vision for what the mutual bank could do. So here we've got the High Street Bank, and hopefully everybody can see this okay. So we've got investments going outside the region, kind of a substantial amount of investment goes outside the region from the High Street banks. They get that money from the region that they're based in. So they'll lend to people here and they'll lend to businesses here, but most of the money is actually being invested outside the region for the purposes of making profits for shareholders. And also, those profits that go to shareholders, the shareholders don't live here. So that, generally, I think there's one maybe director in the Ulster Bank that is actually from, or has a connection with the North, and the rest are just from all over. So these people don't actually, the profits that are generated, they're not even put back in again because they're given to people outside the region. But you can see that the banks actually get their money from people and businesses who deposit that money in there. So again, that goes back to the whole thing about us not having that much wealth, there not being that much wealth, but people are generating quite a lot of money themselves and what they earn, what they save, and businesses likewise. And even say when you save your money in the credit union, the credit unions are restricted in what they're allowed to do with that money. So they have to lend that money out to their members, and the money that they can't lend to members, they'll have to put in a high street bank. So you've got your savings in your credit union, which you think, oh, that's getting used for the community that I live in, but it's not actually. A lot of it could be going into the high street banks again for investment outside the region. So all of that money that's available, and I'm not even talking about the public sector and the amount of money that is sloshing around there that's in private banks, that all of that money, all of that wealth that's generated here is going into high street banks at the minute. There's no other option. There's nowhere else for them to go really. And most of that's getting invested outside the region. So that's a problem. And there's also that whole thing about exclusion that I talked about, that certain people are just unbanked. They cannot get bank accounts. So the mutual bank is here now. So we're saying this is what the vision we would like to see for the region when the mutual bank will be in place. So outside the region now, there's no connection with that because it has to actually serve the region that it's designated for only. So the lending and the investment goes back into the people here and back into the enterprises and the businesses here. So people will deposit their money in the mutual bank. The businesses will deposit their money in the mutual bank. But that will be invested back in the region. It won't go outside the region. So this is a way to retain the wealth in the region. Something, what Caroline was talking about as well. We see that the kind of businesses that the mutuals can focus on and really prioritize are the Indigenous businesses, the social enterprises, the SMEs and micro businesses, including farmers and cooperatives. So Gerry touched on this too. You can see the landscape in Germany and how many small businesses are there and how well served they are by the Sparkassen and the cooperative banks there. And we could have the same here. There's no reason why we couldn't if we also had a community or mutual banking system. These businesses we would see being prioritized, but we would also prioritize in those that have a social and environmental value, knowing the kind of social and environmental problems that there are and how these kind of enterprises, and thinking about the economy in this way as a means to address some of these social issues and these environmental issues. If they were to also focus on using local resources to meet local needs, there again is another way to kind of move away from this kind of very capitalistic, globalized market where we're very dependent on external markets and dependent on a lot of imports, but where we could start to use our own local resources better to meet our local needs, to see how we can actually develop our economy in that way. So I put down some examples here. So say wind and wave resources, we have the best wind and wave resources in Europe, and we're not really using these to any great extent. And we could actually develop those, invest in those sectors to be able to generate our own energy and leave us free of fossil fuels, but also leave us free of the energy dependence and insecurity that we have now. So those are kind of things that the bank could focus on, just very briefly. I mean, there's more complexity to it than that, but this is the kind of vision that we have. And we see this as being something that's better for the region in terms of resilience, making the region more resilient, because you'll be able to try to start providing more of your needs locally with local resources. But it's better for the planet as well, because again, there'll be a huge environmental focus there. The economy can be made more stable. So instead of pursuing this whole idea of growth and what a nonsense that is, and how that doesn't really help the productive economy or most people in society, this is a way to kind of create a more sustainable, steady state economy. And then that would be better in the long term for our future. So that's the kind of vision that we see this mutual bank being able to kind of offer, and to build up a kind of a network of small businesses and co-ops, similar to what they have in, say, Mondragon in the Basque Country. They have their own bank there, and that has been so key. It's been a cornerstone in their development. So just very briefly, I'm going to talk a wee bit about the campaign that we are embarking on here to give you a sense of what we're doing. The first thing is that we're not really starting from scratch or pulling this out of thin air. We're working with a group in England called CSBA. They're the Community Savings Bank Association, and they have a banking model. They're also now developing a whole mutual banking movement. So there's already in England 6 different campaigns that are using the same model, that are trying to create mutual banks for their regions. And there's one in Wales as well. And Wales are expecting to open their bank this year at some point. The model that's available includes all the different components that you need to actually set up a bank, because it's not something that happens very easily. It's a very complex thing. It requires very specialized expertise. You need the right people in there. You need all of that to be able to take it forward, because it isn't a simple thing. It's not something that you do overnight or that you do every day. So we're kind of encouraged by the fact that there is a movement already there in Britain. So we're only tying in with Britain because it's the same jurisdiction, but we're tying in with them. We're getting mutual support from each other, and we're using this same model. So the campaigns that are further down the road, we'll be able to learn from them and, maybe speed our process up. And also it'll show us that the whole thing really works when they start to get their license. We want to have a customer-owned, high street, full-service bank, so all the services, but to cater for these types of people. So just for individuals, for the public sector, for charities, community and voluntary sector, credit unions, businesses, and all of these living in are connected to the region. We would find that a lot of charities, say, for example, or community and voluntary sector groups, find it really difficult to get a bank account set up, and they really struggle, because the Main Street banks I don't see them as very profitable customers. They're not really that interested in them, but they can struggle to get accounts, whereas with this model, that won't happen. And we would see as well, say, the public sector and credit unions being able to use the mutual bank as their bank. So instead of putting all the savings that they can't lend out, credit unions could put those savings, and instead of putting them in a private account, they could put them into a mutual bank account, and then the mutual bank will be able to reinvest that back into the region. The public sector is the same. They have huge transaction accounts that are quite lucrative for the banks. They would actually be helping to retain the wealth in the region as well if they were to bank with the mutual. So that's what we're sort of aiming for. The kind of services that we'll offer will be everything that you'd expect from a typical bank. So you'll have the current accounts, overdrafts, secured and unsecured loans, mortgages, that kind of thing. We propose a mix of physical and digital channels. So there will be internet banking, mobile banking available, because people expect that now. But as I mentioned before, it's really important still to have a presence, to have that physical presence, that people can actually get to know the staff in their bank. When something goes wrong, they know they can go in and talk to somebody that knows them and that will understand their situation. That is so missing from the current banking system, but it's still very much needed. We'll have staffed and automated branches. So there will be, the typical staffed branches, but the automated ones will be really you can have all your sort of online services with access over something like, you know, a remote system like what we're using here today for this meeting, to be able to talk to a member of staff in another branch, in a staff branch. And those automated branches could have maybe staff members coming in a couple of days a week if they had appointments with people and that sort of thing. So we also see that there is a cost associated with having branches, but it depends on what kind of branches you want to have. So if you have these big flagship buildings that a lot of the banks have, then that's going to be costly. But we have sort of the system that we could actually open up a branch out of a shipping container. You know, we could make it that cheap and cheerful. So it's really more about how do we use co-location. So we could share, say, with a community and voluntary sector organisation that had space, we could set up a branch within their premises, pay them rent for that, those banking services right in the heart of the community. So we're looking to see how we can maybe start some of those partnerships with people. And that would lower the costs as well of having branches, but it would mean that we would have a really good reach right across the whole region to be able to provide that access to banking services for people. We've got here population in the north of about 1.8 million. So ideally, it's better to have about 2 million or more in a typical region. But, you know, unfortunately, we're not, the whole of Ulster isn't able to be included in this. But this is the population size that we've got. And in that, there's about 130,000 SMEs with just over 4 billion in lending. And then there's a personal loan market of 1.6 billion. And with our early calculations, we're hoping that we can get, this would make the bank viable, about 6% share of individual accounts, so about 94,000 current accounts, and just over 5% of the SME accounts. So that's nearly 7,000 SMEs. That would be enough to sustain the bank. So this is a very lucrative market. The banks talk as if they are running charities and they've got hardly any money, but this is a very lucrative market. There's a lot of money in it, otherwise they wouldn't be wasting their time on it. So there's enough room for mutuals to exist alongside these high street banks. There's enough room for mutuals in the north, enough room for mutuals and the public bank in the south. So it's not like we're trying to catch a market here that there's very little scope in. There's plenty of room for people, and there's plenty of room for the credit unions as well, as Gerry talked about, to extend their services and maybe have more banking services. So, and we have to do some more research into this, but we do believe that this is completely viable and there's room for everybody. And as I said before, we're open to partnerships with credit unions, post offices, community groups, anything to see how we can work together and how we can maybe co-locate and all of that. So just very briefly then, this is my last slide, where we are at now. We have in the north, the campaign here has an advisory committee assembled. That's to take us through the license and the development stages. We've registered with the FCA as a Northern Mutual. We have a business case prepared, and we have done extensive lobbying with the public sector, community and voluntary sector and private sectors. So our next steps really then are around fundraising and team building. Fundraising to raise the price tag of about 20 million to get this whole thing set up from beginning to end, which is a lot of money, but is not a lot of money in government terms, or, you know, in the kind of economic terms, the financial terms that we're talking about. You build 1.5 miles of dual carriageway for 20 million pounds, you know, so when you put it in that perspective, 1.5 miles of dual carriageway, fair enough, but a bank that will have long-term implications and benefits for a region is a bigger legacy than 1.5 miles dual carriageway. So to try and put that in perspective, the team building piece then as well really is about trying to get the people with the right expertise on board, because you can't even apply for a license with the Bank of England until they have vetted people that are part of the whole process. So we're in the process of doing both of these things at the minute, the fundraising and the team building. We also want to do some further market research. So we've done a bit through the business case already, but we want to do some more of that and to do a more detailed feasibility study. So that's where it's at, and that's me. Thanks so much for having me here.
Thank you very much, Bridget. That was really, really interesting. And I was very interested to hear the mention of Mondragon as well as an inspiration. I won't linger too long because time's going by, of course. So I'm going to just move right on to asking Neasa to speak, and then we're going to take questions at the end. There's been a lot of good questions coming in and comments. So are you ready there, Neasa?
Yeah, so I'm going to try and keep this short, actually, because I feel like usually the best bits of these things are the bit and back and forth at the end. So and I have to say that Gerry and Bridget have covered, and yourself, Caroline, have covered so much of the kind of parameters and the detail of how public banking might work in Ireland. Now, obviously, I think for us, we recently put out a position paper. So we have had a policy of public banking for quite a while. And actually, in our 30-year history, it's something that, in terms of kind of progressive monetary policy, it's something that we've thought about and talked about a lot. And we've had a public banking policy for a while. But we felt that in the last few weeks, just after Christmas, I guess, we were in a particular moment in Ireland in terms of the banking industry. And now was an opportune time to talk about some of these issues. And I think both Gerry and Bridget have gone through the very significant opportunity that public banking would offer in Ireland. As a country, we talk a lot about things like supporting our SMEs, things like regional development and regional fairness, and it's something that we struggle with all the time. So in the wake of the announcement of Ulster Bank to remove themselves from the Irish market, and obviously it's important to say that Ulster Bank was making a profit here. And one of the things that I said in the Dáil is that every private bank, it is their own choice whether they want to stay, and they were making a profit here. They just weren't making enough of a profit here. And banks that are run on that basis, there's always a danger that they will remove themselves from a market with very little buyer leave. They will just pick up and go. And then we were also looking at the removal of almost 100 Bank of Ireland branches. And as anyone who's ever spent any time in Ireland knows, we have lots of small town and villages who require the infrastructure of going about your daily life. So you need a grocer's, you need some kind of access to financial services, you need, a post office, and that's something we're going to talk about a little bit more also. So the things that we asked for, and look, public banking, has gone on a journey in the last few years. I think it was something that was not of any great interest to people before the last decade. I think it was Gerry, or it was Caroline actually, who mentioned that we're still dealing with the aftermath of 2008. And I absolutely think that's true. We often hear in the public discourse about the fact that we own bits of the banks, and why don't we utilize that? Why are we not more assertive in that? And that is a legacy of 2008. And, we still have a number of issues there that we're trying to deal with. So in the last decade, we have seen some interest from various Irish governments around this. There was a government report before the 2019 report, which looked at the issue. There was the 2019 commissioned Indicon report. One of the things that we asked for in our position paper was for that to be set aside or for it to be reviewed. And the reason that is because the Indicon report found that there is no issue with commercial banking in Ireland, that there was enough competition in the sector, that there was enough, not perfect, but enough access to credit, and that the banking sector didn't require, this extra pillar, or I would say it's not extra, but, this formative pillar from my point of view of public banking. But of course, that's not true anymore, because we have seen banks leave and banking closure, and now we are seeing communities without access to financial services. And I guess from my perspective, and it is a particularly green perspective, that will have huge impact in terms of financial inclusion and will have reverberations throughout communities. We also are seeing, and previous speakers have touched on it, a real struggle in other areas of the banking and financial sector, and particularly in the area of credit unions. Their appetite to have the regulation around credit unions reviewed could not be overstated. There's real appetite there to be doing more and to be more active in their communities. And I've met, obviously, kind of higher ups, but I've met, lots of people who volunteer in the credit union, lots of credit union, branch managers, and their frustration with the current system is palpable. And then, of course, we've got the post office service. Now, the post office contracts were changed in 2018. There was a kind of a 2-year moratorium where the government said that they would look at like bringing new services to the post office so that they could be more profitable. That hasn't really happened. So now we're looking in the summer at possibly post office closures. Funnily enough, they'll probably less in kind of small rural towns and more in kind of urban areas where, you know, you have higher ground rents, and that might lead to closures. And people might say, well, if you're in an urban area, you probably have other options. But if you look at, let's say, an area where I live, which is Cabra, that would be an area of, you know, there'd be a lot of low income households. Post offices are incredibly important for financial inclusion. People are in there every day. It's part of their community. It's a really important part of it. So that would be very serious. And then I guess the last thing we ask for is a review, a regional review, and an access to, you know, a review of access to underserved communities to banking services. And by those communities, we don't just mean individual access. Of course, I personally would be very interested in the access to person banking for people with disabilities, for example. I think that's an absolutely valid thing to work towards within the banking sector. But, you know, access for businesses and the community at large is really, really important. So I've kind of hit on some of those push factors already. We have the withdrawal of Ulster Bank, we have the closure of BOI branches, we have fewer financial institutions in general in regional areas, we have a lack of competition in the market. But the opportunity, which maybe we don't talk about enough, is, you know, we could bring ourselves more into line with the EU. We heard, you know, very convincingly there from Gerry about the way this works in other countries and the percentage of the banking market that is taken up by public banking action, and that is as relevant in energy and waste, for example, as it is in money. And so I think that's a really good argument. I think post-COVID, and I'm going to talk a little bit about that in a second, SMEs will be crying out for support. And one of the things that we discussed in the Budgetary Oversight Committee with researchers from the Central Bank was who gets to decide after COVID which small business is viable. And how do they decide that? And I have to say the answers that we got were not very, they didn't ease my mind. And of course, I've talked about financial inclusion and how incredibly important that is. So this is from the Indicon report. I'm going to just go through really quickly what some of the best arguments that I found. If you're talking to somebody, obviously we're in government with political parties who don't necessarily share our vision in terms of the financial sector and the space. So you're constantly trying to, you know, find what are the arguments that work. And so one of the arguments that works, I find, is that idea of regional development and reaching out to communities who don't necessarily have the infrastructure to run themselves. And I have to say, I think that idea that banking is the utility is a basic requirement for a community to operate is very relevant. And you can see here that that's from the Indicon report. This sets out, you know, who lives in rural areas, and you can see that Dublin has a tiny amount, but in Leitrim, it's almost everybody lives in a rural community. And if you do, your access to those types of infrastructure is really important. And as we move post-COVID, if we're the same as other countries, you'll see people moving out of urban areas back into regional areas. That's a good thing for Ireland because, you know, we've struggled to keep people in rural communities before. But to do that, we're going to have to support them to do that. So, you know, we can talk about supports in terms of working from home, but you have to support people to live where they want to live. And a huge part of that is going to be the access to banking. This is from the earlier report, the government report, which I think was published a year before. And I just wanted to mention this in terms of, this is my other best argument, right, which is around SMEs. We are going to see a big discussion around SMEs in the next few years. We know that our productivity level in Ireland could be worked on and could be better. One of the things that we found in both of these reports, and it comes up in research, you know, across the board, it's not an Irish phenomenon, is that particularly with micro, but also with medium businesses, access to a bank is one thing. Access to a local bank has a huge impact on whether you feel comfortable in terms of utilising credit. So if you can build a relationship with your local bank manager or somebody that you know, or a banking service, that impacts how much you're prepared to access credit. And we know that there are many small and micro businesses or small and medium businesses that will need support in the coming months. And if they're not willing to utilise credit, they'll be more vulnerable than they need to be. So I guess, I mean, we've heard a little bit about the fact that in a few years, we're probably looking at some kind of digital currency within the EU. We're also looking at an EU in which we sit that has really changed its tune in terms of a recovery and in terms of how they look at the banking market. And obviously in Ireland, we've lived it since 2008, that kind of austerity and more regressive view of things. But I think in the next few years, there will be a very serious and complex and I hope thoughtful discussion around, I think it was Caroline said the phrase, the role of money. What is money for? And I think for me, and I'm going to finish on this, that includes a huge scope of things. And I think I see Councillor Finn on the call, but she had an idea last year down in Cork around a local currency, which is, you know, has been done, but is really innovative and really about that kind of closed loop of a community and investing in ourselves. For us in the Greens, this isn't a silver bullet. It would sit alongside other things like the Town Centre First programme, which is about, you know, cluster development and supporting people to live in small towns, but also things like universal basic income and a really progressive view of how you support people and work towards financial inclusion. I think we'll also in the next few years as a country have to do things, you know, reappraise what we see as an asset. So for us, that would sit alongside a policy of public housing. I think in Ireland, we're not going to get into this big long discussion, I'm sure, but the idea that housing and land is purely an asset and for profit has gotten us into such a bad place, and we're going to have to reassess that. We also have policies around cooperative business practice, so that where there are businesses who choose to do it, that there would be a more cooperative ownership framework available to them, and that would be supported by the state. Things like ethical trading. We're seeing the UN working on, you know, an ethical trading policy globally, which would be about understanding, you know, the true human cost of the products that you're using. And then for us particularly, tax justice. So it's something that I've banged on about before. Our coalition partners aren't always happy to see me when I talk about this in the Dáil, but our tax policy, particularly corporation tax, is part of that discussion around the financial sector. And if anybody has been reading the news lately, President Biden has come out with some very, I think, progressive but also ambitious positions around global tax policy. And for us, that sits within a discussion around tax justice and financial inclusion and financial justice. And so those are all part of the same story. And I think what we're facing into is that new reality of a post-COVID world. And I would like to think that that's more about innovation, and I would like to think that that's more about recovery. But the reality is, I think, is that COVID has taken or has pulled away lots of our moorings. Things that we thought were immutable, things that we thought we could rely on are not there anymore. And I'm hoping that this is a situation where we're going to build back better. I'm hoping it's something that we're going to try and innovate and make things more about people, and that we're not going to just try and replace and put back all the things that didn't work before, just in the exact same way. And I'm going to finish on that, if that's okay, Caroline.
That's great. Thank you so much. That was really, really interesting as well. It's great to see such a wide range of topics covered, because as you say, so many of these things are interconnected, and things like taxation are very, very important as well as part of the mix. I'm going to move on to some questions. We still have a little bit of time, and I don't know, Bernie, have you got a little bit of questions that you could pass along, or am I?
Yes. I'll go back to the beginning, the people who put them in, and people are trying to answer them in the chat as well. So I'll try and pick out ones that are common. So going back, there's one from Caroline here, which is saying, which groups, politicians and media figures are lobbying for healthier banking in Ireland? And just saying, why is bank and MNC profits so protected? And it links in then to a question from Colette as well, saying, why are the credit unions hamstrung by the 2012 Credit Union Act? So maybe I think that one is probably aimed maybe towards Gerry, as it was earlier on, but anyone can take it. So Gerry, do you want to have a stab at that, why you think they're so protected?
As community-owned entities and owned by their members, they should never have gone under the control of the central bank in the first place. In the US, there is community banks are regulated different to large banks, whereas here in Ireland now the credit unions are under the same regulations as the larger banks, so they have to comply with the same regulations as Bank of Ireland and Ulster Bank and AIB. So it's a huge cost on small credit unions to have staff paid full-time to comply with all these regulations. The credit unions are micromanaged by the central bank. That's the long and short of it. And they will tell you that in private. They may not say it publicly, but that is the situation. They're not allowed to compete with the banks. They have upon 3 million members, yet they have only 2.4% of the market. And they are not allowed to lend at reasonable interest rates.
So there's another comment here saying there was a lot in the talks about SMEs and supporting SMEs, but somebody is saying here that, I think it's Stephen, that SMEs don't want to borrow, that a lot of them have debt already. So does anyone want to respond on that one? I'll open it up to all of you.
It is true that, you know, a lot of the time for SMEs, what they want is just an overdraft, or, you know, it's their cash flow that they're more interested in rather than getting big loans. So the banks don't service that well. They're not as interested in small amounts of money or small overdrafts to really small business. They're looking for, like I mentioned before, the bigger customers, the bigger amounts of money, because that's more profitable for them. So there is a market there for SMEs that really just want to have that regular cash flow. And also social enterprises, cooperatives, sometimes for them, they find it very difficult to get any real kind of service that they need from a bank as well. So it's about that there is a gap there in that very small business, small enterprise world, where it's not big loans that they're looking for, it's the cash flow thing that they're trying to make sure, you know, that they have that evenly throughout the year to be able to meet any kind of financial commitments that come up. And that's the kind of where we're aiming for. So it's that kind of in-between space. So I don't know if that makes sense for people. Maybe Gerry's got something to add to that.
Yeah, just to come in on that, on the SME lending. In Germany, the Sparkassen banks, if they're lending to an SME, it will include 4 site visits to the actual business to see and look at their business plan and where the money is actually being spent. So this is completely monitored what's happening, and the support is there from the bank. So this takes a lot of time and manpower to provide the service. So the big banks are not interested in doing this. The bank needs to have a special mandate to provide this kind of service to SMEs.
Yeah, if I can come in there as well, like we saw from the government report in 2016, 2017, it's those micro businesses that are the highest rate of refusal on loans, and it's exactly what Bridget's talking about, is that they need something that's relatively flexible and often low scale. We know that before 2008, SMEs were more highly leveraged, and afterwards they were incredibly wary of leveraging themselves, and we are still dealing with that legacy. Like as a percentage in Europe, we have very low levels of lending or of borrowing for SMEs, and I think that that's something we have to address. And to be perfectly honest with you, and I don't know if anybody has been watching the Public Accounts Committee, but the SBCI has not really done the job in that sense. It hasn't really managed to offer the type of products, financial products, and the type of access to credit that we had hoped that it would. So I think there's a huge amount of work to be done there.
Okay, thanks very much to everybody for that. Bridget, there's a few questions came up there after your talk. So one from Ian Whitehouse, which is why not utilise existing credit union and on-post branches, and the same kind of thing from Adrian McPherty. What about existing co-op bank and UK post office? Could they not be accessed rather than having to go through the enormous effort to set up a whole new banking option? And would a mutual bank also have an educational mission, you know, to educate people on finance, debt, money topics? And of course, Mondragon has been popped into the chat there, but maybe if you'd like to answer that.
Just very quickly, using the existing structures that are there and trying to maybe upgrade them in some way. The first thing to say is that the co-op bank in Britain isn't actually a co-op. It's not in the real sense of a cooperative. It never was, it especially isn't now, because I think it's owned by, is it Lloyd's, or it's owned anyway by one of the the mainstream institutions. But even at the start, it was always a private bank that was owned by the cooperative movement. So that's the distinction with that. We wouldn't sort of go down the road with them because they're not mutual really anymore, and they're not regional. So they can operate anywhere in a British jurisdiction. So we're kind of regional as well. We need that focus. But the credit unions and the building societies, you know, like the Progressive here and the post offices, it's definitely with the credit unions and the building societies, we could actually try to go into partnership with them, and one of them could decide that they're going to go for this banking license and use the model that we've got, and sort of that would speed the process up. Yeah, you know, if one of them wanted to do that, that would be brilliant. You know, because then it would maybe solve some problems for them, but it would make our job easier. But if none of them are prepared to do that, I don't see why that should stop us from being able to still achieve this. We shouldn't be dependent on these existing institutions and getting their permission or hoping that they're going to come along with us to make this change happen. So yeah, we're open for partnership and working with people, but at the same time, we're not going to let that get in our way. I hope that answers.
Great,
yeah.
Great, thanks, Bridget.
Oh, the educational mission as well, just to say, yeah, I did answer that. I agree that could be a big part of it. You know, it's very much about how people manage their finances and, you know, giving them affordable credit. And there would be big problems up here with illegal lending in loyalist areas. You know, they go in and they threaten people's lives, and they do more than threaten. And there's a big problem with that. So it would be about, we'd be looking to see how the mutual bank could actually address some of those problems too. So yeah, I think there's a big educational piece as well.
I was just about to say that thing about money lenders in Ireland, and we have a huge money lender here that's actually, I'm not, you know, I think it might actually be in trouble, and there'll come a point where people might not be able to access any kind of small loans, and it's bad enough that they have to go through kind of private money lenders already, but like a mutual bank or a small public bank, you know, would be able to do that work of educating people about how to access small levels of credit and really protect people.
Many of the those money lenders are owned by the big banks. They're funded by the big banks. There's a lot of research there on that. Just to say on Bridget's point there, Bank of Ireland are in every post office in the UK. They have a major contract with the UK post office system, and it will cost something like 2 billion to buy them out. So, and that's what's happening here in Ireland now. They are doing they are getting the post offices to provide services for for Bank of Ireland and AIB. They're still servicing Danske Bank, I believe, as well. So they're doing, the post offices are doing agency banking for the banks, for the big banks, and the returns on it is minuscule.
Thanks very much. And I suppose it's great to get all of these things aired as well. Neasa, there's a question for you. It's, did the Irish banking crisis in 2008 offer an opportunity to raise public awareness of alternatives to commercial banking? And if so, was it taken advantage of by the Green Party and others in government at the time or since? And how can public demand for public banking be created so that politicians will start to take the issue seriously? And that's from Deirdre.
Well, I'm very slow to say there was anything good about, you know, the crisis in 2008, and I wasn't in the party at the time, so I can't tell you if it was ever floated, but I haven't seen anything come from it, or I haven't seen that it was particularly pushed in any way. What we did end up with from that was, you know, stuff like NAMA, which I would be very, very, very critical of. So I couldn't really answer that in terms of what actually happened, because I wasn't there, but certainly I have seen no evidence that it was actively pursued at the time. I think ultimately what you're asking is any moment of crisis an opportunity? And I would like to frame any moment of crisis in a positive way, because I think the pandemic has been so hard on everybody. But I do think it has, as I said, kind of pulled apart some of the things that we believed to be kind of pillars of how we run our society, and made us realize, one, that those no pillar cannot be changed, but two, I think we have seen a kind of a recognition of how important like your community is, and your neighbors, and that idea of community action has been so important and so strong, that it's an argument that I find resonates more than I would have expected maybe in the past. It's a similar argument that we have sometimes around universal basic income, where a few years ago people would look like you're absolutely crazy and it was a completely left of field thing to be suggesting. And now you don't get that. Now it's not that they're going to do it tomorrow or we're going to win that argument, but there was a time when that argument was really left of field and really unusual. And now that's not the case. There's a familiarity and an acceptance that there's a validity to these proposals, which you're kind of halfway along the road then.
So we might finish because it's 11:30 already on this last question, and it's a nice one, and I'm going to pose it to Caroline to go right back to the start. It's from Adrian McPherty again, and it's saying really that the modern banking system is sourced from centuries ago thinking, and when we thought that money could grow on trees, and it was developed when the planet wasn't seen as having a limit. So he's saying we're in a very different state now, and these fundamental sacred cows of finance, banking, business need to be reviewed and thrown out to be more harmonious with the ecological cycles of the world. Any views on interest and how this can be eliminated? So maybe to you, Caroline, on that one.
That's a lovely question. Thank you. Yes, well, the money system, as I'm sure a lot of you know, it's a very, very odd system that evolved over a long time. And most money, like 97%, is lent into the economy. It comes into the economy on the basis of a loan, which creates debt. And inherently, that's quite an unstable situation. And there are ways around that. There are ways that it can be done differently. We're actually, I won't talk about it in great length now because I know we're past the time, but we're going to be having a second event in the second half of the year, which will be more about direct, measures about looking directly at where money comes from, what money is, how it comes into the economy. Just to very quickly come back on the interest point, there are actually models of banking that don't use interest for their loans. Like in Scandinavia, there's jack banking. In Islamic countries have explored this as well, though with mixed success, I think, but there are ways that it can be done. You can have more equity-based investment or simply spending, less lending, basic stuff, So, I mean, there's lots of ways that the economy can be reoriented so that it's not so dependent on credit and debt. Yeah, I really hope you'll all be able to come back and tune in for the other event, which maybe I would suggest we could have a little bit longer because I feel like this is really short and I'm really sorry because there's been so many good questions and comments and, we probably should wrap up because we're coming to the end of the time. But I'd just also like to thank everyone again for participating. Thank our fantastic speakers today. Gerry, Bridget and Neasa, who gave really, really great presentations. So thanks you all so much again for all of your excellent questions and comments. And thanks to Bernie for her hosting and Sean and to John O'Connell for his help behind the scenes and Dan Boyle for helping with organising the event. And I really hope you can all make it to our second event later in the year. Thanks a lot. Thanks again. Bye-bye.
Thanks very much, everyone.